the Organization of Petroleum Exporting Countries and its allies, led by Russia, decided to cut their total crude oil production to about 2.2 million barrels per day at their most recent summit in early December. This was the most recent in a string of cuts taken by the cartel in an attempt to drive up global oil prices, the most of which were borne by Saudi Arabia. For OPEC, it is essentially routine procedure. But the cuts were ineffective this year. Reports about OPEC's decreasing significance resurfaced. However, they might out to be somewhat premature, just like previously. This week, Reuters reported that OPEC would soon have less demand in the first half of 2024 for its oil. The International Energy Agency, the U.S. Energy Information Administration, and OPEC itself were cited in the report's forecasts of oil demand, which indicated that demand for the group's oil would decline in the upcoming year. This is probably due to a general decline in oil demand, which the IEA, for example, has been incorrectly projecting for some time now. It seems difficult to meet the level of oil demand that exists right now. Traders dismissed OPEC Plus's agreement to expand production restrictions for two reasons. First, they expected it, and second, there seemed to be a plentiful supply of oil globally. The fact that members of OPEC have a track record of manipulating output cuts is the third reason the market did not take OPEC Plus's moves too seriously. Put another way, even if everyone formally decided to cut, there was likely to be enough oil to meet demand. Moreover, Angola's announcement that it was leaving OPEC in order to pursue its own oil production goals did not advance the cartel's objectives. It sparked calls for a rupture and strengthened the belief that OPEC and its allies in OPEC Plus will always have enough oil, if only because demand declines. It seems like a lot of traders are placing a lot of faith in that particular forecast of lower demand. Furthermore, they are forgetting that at least a few months must pass before production cuts are felt in the physical marketplace. In fact, analysts who were commenting on the December OPEC Plus decision stated that the 3 months that the new, greater cuts are supposed to last will hardly be sufficient to affect supply and, consequently, prices. One such analyst, Adim Zurovic, told Reuters, "I don't think a 3-month cut is long enough to make a meaningful difference in terms of physical supply even if everyone sticks to it. The cuts are only scheduled to last for 3 months and it can take up to 1 or 2 months for cuts to be implemented," a different expert stated. Callum McPherson, head of commodities at Investec, added, "Unfortunately, we won't have an idea of January output until the end of that month, and this is a long time in the oil market." Put another way, the reason why prices are where they are at the moment is that no one is considering the situation of the oil supply in 4 months. This is not surprising, but it is important to remember that these decisions tend to have long-term implications. Take the cautious return to production increase by U.S. drillers as an example. Speaking of U.S. drillers, they are frequently blamed for OPEC's inability to affect prices and the consequent decline in importance that some claim we are seeing. Indeed, despite a declining trend in the number of rigs for the majority of the year, U.S. oil producers surprised everyone this year by adding 1 million barrels per day to their output, thanks to increases in well productivity. However, it seems that a lot of people currently believe that the industry will continue to grow production and improve productivity at this rate. It is possible for this to occur. However, it's also possible that it won't. The IEA has projected a far more moderate rate of output rise this year, at less than 300,000 bpd. Granted, the IEA has been incorrect in the past, particularly this year, as it continued to forecast monthly drops in Permian output while, in fact, this output increased. However, focusing on the here and now, productivity gains are not particularly infinite. There are boundaries. Additionally, there are corporate strategies, which are now concentrated among a small number of companies following this year's flurry of big mergers. Put another way, output will follow the wishes of the major producers, which need not be all the way up. The most recent OPEC death reports are predicated on the idea that U.S. oil production would continue to rise and that oil demand will decline. These two things are not guaranteed. Since BP incorrectly predicted that peak demand had passed in 2019 and that oil demand had begun to decline, oil demand has unexpectedly increased. U.S. oil producers have surprised everyone with their self-control and their newly discovered dislike for increasing production at all expense. All OPEC needs to do is bide its time until demand absorbs the levels of comfortable supply that traders attribute to the low prices. Despite the fact that its percentage of the worldwide total has decreased due to the cuts, it remains relatively stable at 27% of the total. Additionally, it has a spare capacity of about 5 million barrels per day, which it may or may not choose to use in an emergency. Again, OPEC's death has been excessively exaggerated. Since the beginning of the year, there has been a narrow range in the price of crude oil as Middle Eastern geopolitical worries offset ongoing economic concerns. Nevertheless, benchmarks saw a drop on the first trading day of the year as concerns about the U.S. economy in particular momentarily overshadowed worries over a further escalation in the Red Sea. Equity markets were also lower, and energy markets were unable to withstand the wider assault on risk assets. The Middle East's tensions are getting higher, but oil is still weakening, ING's Warren Patterson and Eva Manthi stated in a note that was released earlier today. The commodity analysts continued, a fairly comfortable oil balance over the first half of 2024 does help to ease some of these worries, even though the geopolitical situation is a concern for the oil market. ING experts pointed out that there is no more room for further production cuts when OPEC announced that it would meet in February to examine its current production cut program. Patterson and Manthi observed, it is getting harder to get all members on board to cut. Already, the last few rounds of cuts have been driven by voluntary reductions from individual members rather than group-wide cuts. According to senior analyst Neil Beveridge of Sanford Bernstein, there's not really any disruption to the physical supply in the market as a result of the events in the Red Sea, Bloomberg reported. OPEC has a lot of work ahead of it to maintain prices at current levels, as markets appear fairly balanced heading into the year. The average U.S. benchmark oil price will remain below $80 per barrel in 2024 due to anticipated lackluster global economic growth, according to the monthly Reuters poll, which saw analysts lower their 2024 expectations from the previous month's estimates. The average price of WTI crude, the U.S. standard, is predicted by 34 analysts and economists in a Reuters survey to be $78.84 per barrel in 2024. The survey was conducted on Friday. The experts' prediction for this month's consensus price was lower than their prediction for November, when they predicted that West Texas Intermediate will average $80.50 a barrel in 2024. The consensus estimate for Brent crude prices in the poll from last month was $84.43, but it has since dropped to $82.56 a barrel on average for 2024. Just one respondent out of 34 in the December study predicted that the average price of Brent crude would surpass $90 per barrel by 2024. The average price of a barrel of Brent crude this year has been $82.17. On the final trading day of the year, the front-month Brent crude contract was trading somewhat higher early in the day on Thursday. Brent set to close 2023 below the $80 per barrel threshold, down around 10% from 2022. This is the first yearly drop in oil prices since 2020, when the pandemic severely reduced demand for the commodity. This year, OPEC Plus production cuts and the Hamas-Israel conflict have mainly been ignored by oil prices, which have been negatively impacted by worries about economies, oil demand, and higher than expected non-OPEC Plus supply growth. However, participants in this month's Reuters survey said that volatility in oil prices could potentially grow next year due to geopolitical flare-ups. However, a few of them suggested that demand growth would be weaker. Thomas Wyby-Eric, an analyst at Norland, told Reuters that we do not expect much impetus in the months to come from the demand side. And that's it. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.